Will mortgage rates move lower? With the Trump presidency, we're likely to see interest rates remain higher for longer. First, the Federal Reserve. The Federal Reserve is facing some inflationary pressures, and this week and next week we get two economic data points that are probably going to show that the U.S. economy is expanding a little more rapidly than the Federal Reserve would be comfortable with, considering they've not hit their target rate of 2% annual growth rate in inflation. We get non-farm payrolls on Friday. Next week, we get inflationary data points themselves, PPI and CPI. Those will likely show upward price pressures. Given that, the Federal Reserve has already mentioned that they're not going to be lowering short-term interest rates anytime soon. Then we factor in two aspects of what the Trump presidency will give us. First, tariffs. Tariffs will is a Tariffs are a tax on consumers. Any consumer goods that are purchased, that are imported into the U.S. economy, will be taxed at a higher rate. This will drain finite incomes consumers are earning at this point, which means lower consumption rates. Then we factor in the extension of the tax cuts. If the economy begins to slow down with the tax from tariffs, which it will, the next is the deficit. We're now currently running a 120% debt to GDP ratio. If the economy begins to slow, an economy that is fairly strong at this point, less tax revenue will be generated for the federal government. At the same time, the tax cut extensions will add to the deficit itself. President-elect Trump will turn 120% debt to GDP ratio. He'll easily push 125, 130, 150% debt to GDP ratio. The long end of the yield curve, the U.S. Treasury rates, will continue to rise. This affects mortgage rates. Your potential mortgage rate will remain higher for longer based on these three aspects of the economy right now.